Mahesh Patil, who's joining us right here in the studio this morning. Mahesh, good to have you with us.
Yeah, good morning.
Good morning, and especially at a time, Mahesh, when markets don't seem to know which way to go. We're off to a good start today. Yesterday was dismal when you were looking at the broader markets. You know, we've got BofA coming out and talking about how they haven't seen the mood so somber in the last 10 years or so. What are you making of it?
Yeah, so I think it's been difficult after the election results. One would have thought that there would have been a broader participation in the market, but things haven't been exactly great, both in terms of news flow on the global front as well as on the domestic side. I mean, globally we've heard about trade talks, which have kind of led to, again, a big fall in the global bond yield. So there has been some kind of a risk aversion which is reflected in that fact. And domestically, I think some slowdown what we've seen, and also the NBFC crisis has dampened the sentiment a bit. So I think market is trying to, again, Nifty itself, where the valuations are, it's probably likely to be in a consolidation phase, because downside probably might not be much, because after the election results, there is people are willing to take a slightly longer term view on the market, ignoring the near term concerns. But the immediate triggers for the market, whether it's in terms of earnings traction or growth, is slightly missing. So I think you might see some kind of a consolidation or time correction in the market until we see the sentiment start to improve on the domestic front.
So this crisis of confidence which is currently playing out and largely got to do with liquidity within the NBFC and the banking system, Mahesh, is that trickling down to the retail investor? Because the AMFI data doesn't seem to be indicating so, but perhaps you would have a closer handle. Are you getting queries? Are you getting any redemption? Is money moving out of small and mid caps and, you know, getting concentrated within large caps, or any that sort of shift which is happening?
So if you look at the domestic retail flows for the last couple of months have been fairly weak. The number is around 3,000, 4,000 crores on a monthly basis. So while the SIP book is steady at around 8,000 crores on a monthly basis, that means there have been redemptions, right? Because if a net flow is around 4,000 crores,
right,
and that is coming through from a lot of HNI investors, people at these levels are probably seeing to take away some money from the market. Near-term outlook is not looking that great. Long-term investors are still put, because long-term investing is still going on, because I think the long-term outlook still looks fairly decent, I mean, in terms of growth. So yeah, so clearly there is some nervousness which is there from the retail side, but people are not panicking. Long-term investors are continue to invest. And in terms of the money flow, I think it is moving across. We're not seeing any kind of, despite the mid-cap correction, there is not a big outflow in the mid and small cap. In fact, after the elections, we would have seen some money moving into the small cap and mid cap space. Not a big one, because the valuations there are looking slightly more attractive. And long-term investors would see that an opportunity to get into it. But otherwise, bulk of the money is moving into the multi-cap and large-cap categories. The balanced funds are seeing a good amount of outflow. So it's
outflow.
Yeah. So that's been a trend now for quite some months, because we saw huge money come in last year in that category. But it's essentially in the large cap and the multi-cap space where the big inflow is coming in.
Debt funds also, you know, past instances have taught us that just nothing is safe, everything comes with a big risk.
Yeah.
Are you seeing a massive outflow after the past few instances within debt funds?
So debt funds, again, some kind of nervousness there, investors, because investors didn't expect this kind of NAV, whatever, downside on the debt side.
Everyone thought debt would be the safest option, right?
So in debt also there have been some concerns on the credit funds, where we've seen some outflows. But again, it's still not, a lot of institutional investors, who we're talking to, I think they are still where they understand underlying debt portfolio, what is the risk. Retail investors are kind of slightly panicking, but again, we're not seeing very large outflows over there. Net inflows are definitely stopped in that category. And as the sentiments improve, I think as we see some resolution of some of these accounts, and people actually see some write back of some of the provisions which have been made, I think that's where the sentiment could improve around the sector. I mean, our belief is that the bulk of the pain in terms of the credit losses, what we have seen, it's largely behind us. I mean, we don't see any incremental pain on the debt side.
You've got a new NFO coming up as well, Mahesh. Let's talk about that. It's a pharma and healthcare one on the 20th of June.
Yeah.
It's an interesting time. Pharma's been fairly had had huge regulatory overhangs. Maybe not so much the domestic focus names, but what's the thought behind it? Talk to us a little bit about the structure.
So I think the pharma sector has been reeling under the pain for the last couple of years. And the main reason for that has been the US, right, where the generic companies had seen a huge amount of pricing pressure in the last 2 years, price erosion to the extent of around 15% or so. So I think that is kind of easing off based on the commentary what we hear from the large generic players, and primarily because of the fact that a lot of the generic players are vacating the market because prices have come down, some of them are uncompetitive, and that has eased off the pricing pressure. So that's one. And a lot of Indian companies had invested in R&D in the last 4-5 years. I mean, R&D spend, which used to be around average 2.5-3%, has gone to around 8%. And the results of that, and that spend has been mainly towards upgrading and going up the value chain into specialty drugs and the complex generics. So those are likely to fructify in the next couple of years, and that will compensate for the loss erosion in generics pricing. And the domestic pharma story looks fairly good in terms of growth. And I think what government is doing on insurance and Ayushman Bharat, that will mean longer growth for the pharma company. And also, if you look at the demographics in the country, which is people under the age of 5 and above 50, so that percentage is going to increase. So these are long-term drivers for the domestic pharma space. And more importantly, the valuations are looking very comfortable now. So at around, if you look at a price to book value multiples for some of the large pharma names, they will be almost 40-50% lower than the peak. And so the risk reward clearly looks favorable from here on. And the risk which was there from the US side, that proportion as a percentage of the overall value has come down dramatically.
So Mahesh, if one had to construct a portfolio, say for the next 6 months, for the next 1 year, and then for another 3 to 5 years, where do you think the concentration of money can be made in the near term, in the medium term and longer term? If you had to asset allocate for a retail participant who comes to you looking for advice, would it be balanced funds, would it be small caps for the next 3 months or 6 or whatever, or would it be gold, which is now actually at a 6-year high? It's been a very steady, sharp uptick that one has seen, so maybe some ETFs.
So if you look at asset allocation across asset classes, then I think at this point in time, the risk reward across asset classes is fairly well balanced.
Okay.
So one wouldn't advise aggressively to put any particular asset class. If you look at equities, long-term outlook is good, but returns would be more moderate. Debt also, after the recent pain what we have seen, I think looks to be a fairly good time to get into it, because interest rates are also likely to go down. And as you rightly said, gold also, after the underperformance, whenever asset class underperforms for 4-5 years, and looking at how the global scenario is panning out, would not be a bad asset class to look at. So I think it's right time to actually put up money across asset classes. I mean, depending on each one's risk reward. So that's one. And within equities particularly, I would say that the larger money allocation should go into a multi-cap category, because I mean, large caps have done well. Valuations are expensive over there. Again, it's skewed to a few stocks, so there is still value in the large cap, but mid and small cap is also offering opportunity in this context. It might probably not recover immediately looking at the sentiments, but with the 3-year view, there is enough alpha which can be generated over there. So multi-cap would be a larger allocation, say around 40% or 20% in a large cap. Mid and small cap should also be, one should also not overlook that, despite the underperformance in the last 1.5 years or so. So around 20% in a mid and small cap, and another 15-20% can be in thematics fund, like what Pharma fund, okay, which we are coming out, or any other theme, like a consumption theme, okay, which we think is still a longer term theme, which will do well.
Sure. So on one hand, there's the demand story, Mahesh, and on the other hand, there's the, I mean, in the sense there's on a macro level the demand story. What will boost demand, what will get things going, and on the other hand, there's also the earnings recovery, right, where there are expectations perhaps from certain companies that they'll manage to kind of get things going regardless. What's your sense going forward? How much time do you see that taking? Where are the pockets that you see that recovery coming in?
So I think the current slowdown, what we have seen in a few sectors, especially consumption, we think it is still cyclical. It's not a structural slowdown. I mean, there are various factors which impacted that. To some extent, the problem on the the liquidity crunch, what we are seeing, and the NBFC is also contributing, especially in the consumer discretionary side. So I think as things normalize over there, you should see the demand growth also start to come back over there. Also, the stimulus which the government has given in the budget in terms of transferring wealth at the hands of the rural and the lower middle class, I think that impact should also flow through. Obviously, the rural is again a large part of the consumption basket, and the monsoons, how they pan out, I mean, the initial indications haven't been that good in terms of the onset of monsoon. But yeah, if monsoons are fairly okay, I think we should see demand recovery in the second half of this fiscal year. And given that, I would say that on the consumption side, especially small ticket discretionary consumption, I think should come back fairly strongly. We've seen on the consumer durable side, like for example, the sales of air conditioners, TVs has been fairly strong in this last couple of months. And so I think in a couple of quarters, I think we definitely, even autos for that matter, there is a lot of weakness. If you look at the commentary from the auto OEMs, it's fairly bleak. Inventories have increased, but I think, I mean, I wouldn't say again autos structurally should be at the level where it is. I think the medium-term growth should be somewhere around 6 to 8% volume term at least. And I think you should see that coming through in the next couple of quarters or so. Apart from that, I think other areas where on the execution side, we've seen the infrastructure sector. I think after the elections, again, you will see some pace increasing over there in terms of execution. And some of these companies are likely to report fairly strong growth in terms of revenues.
Right. Mahesh, you were making the point about, a balanced approach when it comes to asset allocation, and you mentioned gold as well. But in the next 3 to 6 months, do you think there could be high alpha generation purely in gold? Just looking at the dynamics, it will not be equities. Maybe the precious metals will give you higher returns?
Again, very difficult to say that. Probably, again, relative terms, probably it could do better again. But again, gold will not be asset class, okay, which will give you wealth creation over the medium to long term. It's a more of a balancing part of your portfolio to reduce your risk, and because the correlation of gold is a hedge in that sense. Yeah. So absolute returns in gold will be could be there, but it will still be moderate. But as an asset allocation to really balance the portfolio, I think it would be a good asset class to make some allocation over there.
But in the near term, you would say when it comes to equities, safest to be in large caps?
I would say, yeah, I mean, large cap would be more little safer, but again, the return expectations on the large cap would be moderate because if you look at the Nifty valuations currently where they are, even on a forward basis, it will still be around 15% higher than the long-term average, whereas mid and small caps would be somewhere near the long-term average. So there is a trade-off there in terms of safety and returns, okay, what you would get over the medium term.
Since we're talking about gold, of course, a lot of what happens in gold is really dependent on, what we see coming out of the US in terms of, the trade wars, tensions, safe haven buying. How sensitive do you feel we are currently in terms of what's happening on with regards to some of these global factors, or do you feel right now the pain is more domestic and markets are more attuned to really what's happening here with regards to specific companies?
So I think on the global front, the scenario what we are seeing, with some trade and tensions between the US and China, unless it doesn't blow up into a full-fledged trade war, it's not necessarily bad from India perspective, because you've seen as a result of that, central bank monetary policy has been pretty dovish. We have seen the bond yields come off, and relatively India looks to be better placed in that context in terms of relative growth. Also, global growth has weakened a bit, so that is not bad. In fact, as a result, we haven't seen FI. I mean, while there have been outflows, FI outflows from the emerging market, we have still seen inflows.
Sure.
But yeah, currently I think domestic factors are probably weighing down more on the market in terms of the near-term challenges, slight slowdown what we are seeing, and the liquidity concerns which are there. So I think if we overcome that, I think we could see the markets recovering a bit from here.
So do you think that things are more likely to in fact get a little bit worse before they get better?
So I think again, I think we've seen to a large extent the concerns are pretty much known in the market.
Yeah.
So you might see some kind of a time correction or mild correction in the market, again depending on how the global cues are. If I take a medium to long-term view, I think at least for India, the story, I think we have to see again how the new government, what are the policies it sets for the next 5 years, and that will provide more direction in terms of long-term investors really who want to bet on India. So I think in the near term, probably the upside in the market looks limited, there could be some mild correction from these levels. But I think that's a good time to really enter for investors who have been waiting on the sidelines or really want to participate in the long-term wealth creation.
Okay, Mahesh, great to have you on the show as always. Thank you so much for taking the time out and, of course, advising our retail viewers on how best to asset allocate in this current market scenario, both from a short to medium to longer term basis.